Okay, so again, welcome to this year's last lecture. We've started last week to talk about investment banking, and if there's one message you should take from this introduction to investment banking, it is that all the services provided by investment banks are somehow related to capital markets, and they're usually part of the B2B side of a bank's business. You don't have retail customers here, but usually you have business clients, you have corporate customers who are in need of some kind of assistance when it comes to financing. And as you can see, after our short introduction, we now want to concentrate a little bit more on the valuation side of investment banking. Then we'll talk about leveraged buyouts, IPOs, M&Os, and trading and structuring on just a couple of slides. The basis for many services provided by investment banks is actually balance sheet analysis. And investment banks support their clients in numerous ways, both in finding investment opportunities, in finding the right investment asset into which the customers can put their money, but also in finding the right financing structure, the financing possibility, for example, to finance an IPO, well, not an IPO, but to finance a merger, to finance a large acquisition, and so on. And in many of these cases, the investment bank will try to help you as a customer by giving you an idea of what an asset, what an investment is actually worth, what the true value of an asset is. This asset could be in a stock, it could be a bond, it could be some other kind of security, it could be a structured finance asset, it could be a company. And of course, when the investment opportunity becomes larger and larger, it becomes more and more difficult to value this investment. And this is what investment banks do most of the times. They do corporate valuations, they do analyses of companies, because if you want to know what a stock is actually worth or should be worth, well, it's closely connected, of course, to the value of the company. So what can you do? You will try to use all available information, or publicly available information on a company. And you will find annual or quarterly financial statements. You will find publicly available market data, stock returns, stock prices, etc. And you will try to use all this data to come up with an idea of what the company should be worth. And for example, I could give you an example. Let's take the perfume store right across the street. I could ask you, what is this chain of perfume stores worth? And you would start by taking the balance sheet, you would start by taking the income statements, and you would try to analyze these reports and also some publicly available information, and you will come up with a corporate value. Now, this is something that is quite complicated, and usually, and here at our faculty, we also have one colleague who specializes on corporate valuation. Professor Diedrich has a whole module, I think, that is dedicated to corporate valuation, Unternehmensbewertung. And and before discussing these basics of business valuation, we will shortly discuss the basics of just balance sheet analysis, because this is what mostly corporate valuation is actually about. On an interesting side note, if you ever apply at a job, even for an internship with a large investment bank, thinking that this is the pinnacle of your career in finance, and for some people it is, because the investment banks will be the ones paying you the most money. You might have already heard that, for example, strategy consulting firms have a very special way of selecting people in job interviews. They do case studies, And it's more or less the same with investment banks. Investment banks will probably provide you with a case study for a valuation. And they will give you this data, and they will tell you, okay, you have 15 minutes and evaluate this company. And if you especially are interested in getting a job in the US at Wall Street, you will find large books that aim to prepare you for this type of job interview. Doing your first job interview at an investment bank. It's not the regular job interview, but you have to do a valuation. Okay, so balance sheet analysis is something you have to do when you want to come up with a value of a company. And here you can find the balance sheet of Ryanair a couple of years ago, actually 10 years ago. And you can see that on the left-hand side, on the asset side, you have current assets, non-current assets, something out of the ordinary. If you look at the asset side of this company, what is most striking, if you have a quick peek at this balance sheet, what would you expect? An airline, what type of asset does it hold? Yeah?
Pretty high fixed assets, non-current assets.
Yeah? Why?
Like, for sure, property, plant and equipment, so all the...
And you can already say what is probably behind this figure? Planes. Yeah, obviously. It's an airline. It will own, it's an airline that actually owns some planes, so you can see that they have 3 billion euros in planes on the asset side. Actually, a lot of cash and cash equivalents back then. And here on the right-hand side, you can see they have some liabilities, quite high shareholders' equity, which is not that surprising because for once, we're not looking at a bank. If this were a bank, you would immediately see that something is off because it has such a high equity ratio. But as this is a non-bank, a non-financial company, this is not that surprising. But banks usually have a much lower equity ratio. And the income statement for the same year, you can see that they have some operating revenues, they have staff costs, depreciation, and also not so surprising, they spend almost 600 million euros on fuel. And here you can see that for an airline, they spend almost 3 times as much money on fuel than on staff. So this is the largest cost factor here for an airline. And they have revenues of 2 billion euros, and they made a profit of 455 million euros at the end of the year. Okay. They also rented some aircrafts. They had route charges, airport and handling charges. This is also quite high. And this is the income statement. You also have a cash flow statement, and I think you probably know how a cash flow statement looks like, so I'll just skip that. But the basic line here is that for any company, you can find an annual report, you can find maybe even a quarterly report, you can find income statements, and these give you a first idea of what is going on in a company. And if you've ever taken a basic introductory class on accounting, just most of the German students will have done so, you will know that the balance sheet tells you a lot. It doesn't tell you everything, and it depends on what you do with these figures. For example, these are all absolute figures in euros, so it doesn't make much sense to compare these figures with any other company. You have to use ratios. You have to use ratios that are not biased by the currency, or you have to use figures in the same currency to make these figures comparable. And this is actually what balance sheet analysis is all about, making balance sheets comparable and coming up with ratios and some proxies and measures that can be compared across sectors, across countries. And this enables you to calculate corporate value, company value. It's the first problem that will arise is that Financial statements coming from different countries, even from the same country, from different sectors, are not directly comparable because they have been put up and made under different regulatory regimes and under different accounting regimes. In Germany, you have most companies filing their reports under HGB, HGB, which is the German Handelsgesetzbuch, the trade law code. You have IFRS. Large companies will file their reports under IFRS, and US companies will use US GAAP. Is there such a big difference between these accounting systems? What do you think? Yeah?
Yes, it is.
Yes. There are extreme differences. I will give you one quick example that will highlight how extreme the difference can be. Take, for example, Deutsche Bank. Deutsche Bank is a German bank that files its reports under IFRS. And under IFRS, it has only little leeway to how do you say that in English? To consolidate their balance sheet position on derivatives. They have to report all the derivatives they have, even if they are for hedges, and even if they balance out. So under IFRS, Deutsche Bank used to have total assets of almost 2 billion euros. Same bank, same balance sheet under US GAAP, where you have the possibility to net derivatives positions, 1 billion. So only half of the balance sheet under US GAAP, 1 billion total assets, 2 billion euros under IFRS, because IFRS wants to see all the derivatives positions without too much netting. So there can be extreme differences between IFRS and US GAAP annual reports and financial statements. Of course, even in one single country, there are extreme differences from one sector to another. We've seen, or we have not yet seen, the special rules in accounting for banks. Yet we'll see that next year. But banks have special rules and have some specific laws that govern and rule the accounting for banks. The same applies to energy companies, insurance companies, and of course industrial companies. So you cannot simply compare a balance sheet of a bank to one of, for example, a perfume store chain, because it's different. And of course, it doesn't make too much sense to compare Ryanair with Lufthansa and British Airways, because these companies are much larger. So it makes more sense to use ratios. And of course, if you compare figures from different countries, you will also have differences due to exchange rates and different currencies. So you need to make these balance sheets more comparable, and the way to do this is to use ratios. So you will calculate percentage quantities and ratios, and these will make it easier to compare the information given in an annual report from one country, from one company, to the ones given by another company. Okay. Okay. So the first idea is to simply put all the figures given in the annual report in the balance sheet as a percentage of total assets. And here you can see that, for example, Ryanair had 55% of its assets, more or less, in planes. It had an equity ratio of almost 44%. And of course, at the bottom, you can see that it has to round up to 100%. Okay. 7% in financial assets and 25% in cash. So this is a better way to look at this company. And if I told you, for example, that British Airways had only 10% in cash and 70% in planes, one could immediately get a feeling of how liquid one company is, how well The asset side is for Ryanair or for British Airways in comparison, and this is a better way to do this. Okay. You can also see that they only had 0.85 and 1% here in derivative positions. First, quick and trick question: why are the derivatives on the asset and the liability side? Does everyone know what a derivative is? Who does not know what a financial derivative is? Okay, who can explain what a financial derivative is? A financial derivative is a security or a financial contract whose value is derived from another security or another financial contract. So, for example, a stock option is a derivative because the option gives you the right to buy a stock, a certain specified stock. And if you have the option to buy the stock, the value of the option will depend on the value of the underlying stock. So it's a financial derivative. Okay. And why are the derivatives on the asset and the liability side? Idea? Yeah?
Because you can be on both sides, so you can either have the right to buy something or you
can be long and short in a derivative. If I sold you the option to buy a stock, I am short and you are long in the option, and you have the right to buy it, and if you exercise the option, I have to deliver the underlying. So I have an obligation to deliver this to you. You pay a fee to me, and in this way you are the owner of the derivative and I am the writer of the option. And depending on what position I've taken, long or short, this derivative will pop up on the asset or liability side of the balance sheet. And if you have bought the option, this is an asset for you. You can always decide to let the option expire and you will have nothing. You will probably need to write off the option. But if I've already written an option, I will have some cash and I have the pending liability that if you exercise the option, I have to pay out something in the future. So this is a liability to me. Okay. And as you can see here, they have less than 1% in derivative contracts. This again shows you this is not a bank. This is a financial. Actually, it's quite large for an industrial company because usually industry companies don't have financial derivatives at all. Why do they own derivatives?
maybe because they want to secure themselves for rising fuel prices and so on.
Hedging against oil price changes. This is, I think, the sole reason why they have financial derivatives. They want to hedge against increases in fuel prices. Okay. Same here for the income statement. You can see that as a percentage of the total operating revenue, you can see that they have generated 83% in their scheduled revenues, and they had 10% of their total revenues. They spent 10% of their total revenues on staff, 28% on fuel and oil, and then you can see they had a profit in terms of their total operating revenues of 21%. And then, of course, this is independent of the currency, and you can compare this figure with similar ones from other companies. Okay. Now, what could I do to evaluate the corporate value of Ryanair? First thing would be to do a time trend analysis. For example, if I saw that in this year, 2007, they had a return on equity of 6%, or they had a percentage of profits over total revenues of 22%, I could just look at the time trend. And I would see, okay, they have a rise and strong increase in the return on equity from, let's say, 4% to 6%. Then I would say, okay, this company is doing better and better each year. Second possibility would be to do a peer group analysis. if I would see that Ryanair has a return on equity or profits over revenues of 22%, but actually British Airways is here, same year, 8%, Ryanair would underperform. And I can compare the figures for different companies in the same year in the cross-section, and I would see that Ryanair is doing quite well, or it's doing actually quite worse than its competitors. Then you have a peer group analysis. Okay. So you will use financial ratio. Yeah.
But another kind of a limited view, because the first possibility is only looking back in the past, and the second one is only looking for the current situation and looking forward.
You will find this anywhere and everywhere in the business world. First, you will always find comparisons in the cross-section. You might remember the famous exclamation by Josef Ackermann, the former CEO and chairman of Deutsche Bank, who argued that Deutsche Bank needed to have a return on equity of, I think, 20%. That was his goal, for Deutsche Bank to have a return on equity of 20%. Totally ridiculous, but still, he wanted his bank to be the most profitable one in the whole sector, in the whole banking business. So you will find these comparisons in the cross-section. And yes, a time trend analysis is always a look back at the past, but still you will see a trend that will probably also forecast into the future. And this is probably what is usually done with startup companies and with companies that are hard to evaluate. And I think this is also, those are the companies for which valuation is most needed, for those companies where you cannot actually forecast the future, but you can only see that over the past couple of years they've put up a fabulous trend. And this is usually true for startup companies. Okay. So you will use financial ratios to analyze the performance of a company, and these can be divided into short-term solvency and liquidity ratios, long-term solvency and liquidity and leverage ratios, asset management and asset turnover ratios, profitability ratios, and market value ratios. And you will probably know most of these ratios. For example, the current ratio, current assets over current liabilities. It simply shows you what could happen if if my company was in trouble today. I would see that I would have to satisfy all current liabilities and pay out all current liabilities, and I could only use the current assets. Here, for Ryanair, the current ratio in 2007 equaled 2.11, which means that for each dollar or each euro in current liabilities, they had 2.11 euros in current assets. They could be able to sell off, or is already in cash, to fulfill their obligations. So quite liquid. Okay. What does it tell you? For creditors, especially short-term creditors, such as suppliers, the higher, the better. The higher the current ratio, the more liquidity a company has, and the less likely it will default. For companies, a higher current ratio indicates sufficient liquidity, but on the other hand, cash doesn't generate profits. So if you have a current ratio of 10, this only tells you that your money, your capital, is sitting around idle in your company, and you need to do something with the current assets. You need to spend your cash on some investments to generate profits. So a current ratio of less than 1 A current ratio of at least 1 is desirable. A current ratio of less than 1 is highly problematic and could even mean you're close to bankruptcy. But if you have a current ratio of higher than 1, this means that you are wasting opportunities to generate profits. Long-term solvency ratios. total debt ratio. You take the total assets minus total equity over total assets. And this is just what? It's in other words, total debt or total liabilities over total assets. In German, it's quite simple, Verschuldungsgrad. Debt equity ratio, it's the same. It's just total liabilities over not total assets, but total equity. And these two figures tell you what? The overall leverage of the company in the long run. This is not the short-term viewpoint, but it's in the long run. Okay. You had a question? Okay. If you, again, switch it, if you take total assets over total equity, you have an equity multiplier. And in 2007, Ryanair had 56% debt, which means they had financed €1 of assets with 56% in liabilities and debt. And this, of course, is also closely connected to an equivalent, actually, to the leverage ratio. Okay. Profit margins. Profit margin is a profitability measure. It's net income over total revenue. It tells you how much money you make for each euro or dollar or yen in revenues. In all things equal, a relatively high profit margin is desirable as this corresponds to low cost to sales. I think this is quite clear. However, while reducing sales and sale prices usually leads to increased sales volumes, it reduces profit margins at the same time. Similarly, total income could have gone up or down, therefore it's not necessarily bad if margins are smaller. It simply tells you what? If you sell €1, it might simply be that the profit margin of your specific product is quite low and quite small. There are some industry sectors in which the profit margins are notoriously small because you cannot make a large profit on, say, on candy sweets. It's a different story when you sell cars, and it's different when you sell luxury goods. Usually for luxury goods, the profit margins are extremely large. Why? Because the volume sales and the sales volumes are small. You're not selling millions and millions of Louis Vuitton handbags. So the profit margins have to be large. Okay. So it's desirable, but it doesn't tell you too much how profitable you work. A better idea is to use the return on assets. It's net income over total assets. And this return on asset ratio tells you how much profit you make and how much income you generate on each euro, on each dollar in total assets. So if you've spent, if you've invested 1 million euros in equity and you have no debt, this immediately is also the return on equity, and it tells you the return on your investment. If you have debt and equity, this is the return an average investor gets. It's over total assets. For Ryanair, it was 7.75%, so not so bad, especially in the airline business. So you generate 8 cents in profit for each euro in the total assets. So if you have a new plane and your return on assets is 8%, you know that if you spend another 100 million on a plane, you will generate approximately 8 million euros in income for this year, if you keep up the business in this way. Return on equity tells you what the net income is for each euro in equity, and this is return for shareholders. And for Ryanair, the return on equity was almost 18%, which is not so surprising. Why is it not so surprising? Does this surprise you? 18% return on equity for Ryanair. Have you ever used Ryanair? Probably. This is 10 years ago. This was during the phase in which Ryanair started to change the business they were in, and this was one of the first low-budget airlines. And when they started to compete with the large ones, of course, they were the disruptive innovator in this whole sector. And at that time, they were incredibly profitable, and they had an incredibly high return on equity. It has probably changed since then, because some other companies have taken up the same business model. But back then, they were highly successful. And you can see this in this enormously high return on equity, 18%. Of course, they also had a large risk because, back 10 years ago, no one was able to forecast the longevity of this business model if they were able to compete with the large ones. Okay. Return on assets and return on equity are frequently used and quoted figures. They are accounting returns. So to be exact, one should note that these are returns on book assets and the return on book equity. What does that mean? Why is it important to stress that these are book accounting values and the return, for example, on book equity?
Because it depends on the accounting rules you're using.
Yes, but also?
On the time shift between the book figures getting audited and the point of time when they get published.
Also true. But if you have a book value, you also have a?
The market value.
Yeah. It could be. Imagine that you have a company that has a total equity of 1 billion euros. But it could be that the corporation is valued at a much higher price than 1 billion. If they have stocks and the stocks skyrocket, the market value of equity will be much higher than the book value of equity. The book value is an accounting figure from the balance sheet. But the market valuation could be totally different. So this is the return on the book value of equity and not the market value of equity. You would have to use the market capitalization to get the market's impression of the book, of the value of the company's equity. Okay. Yeah.
This again depends on the accounting rules and the sector, right? Because
Yeah.
the last session of the before you told us about the American bank that they had to write off all their housing
Yeah.
loan things, although they still had
Yeah.
value, but no one wanted to buy them.
Of course, the book value and the market value of equity will not be completely off. But if market participants, take for example Facebook, if market participants believe that this company will perform exceptionally well in the next 10 years, the market value will be much more off than the book value than for a seasoned company that has been around for 100 years. So, for example, for Bayer, for Henkel, Henkel is not listed, I think, for Bayer, for BASF, for Siemens, for these old industrial companies, the book value of equity and the market value of equity will almost be the same. But especially for startups, where it's not all about accounting rules and it's pretty much about the expectations of market participants, the market value will not be reflected in the book value of equity. Okay. You have the return on equity, and it's actually quite instructive to look at this decomposition of the return on equity. It's net income over total equity. And then you can write times assets over assets times revenue over revenue. Still equal. If you rearrange this, you can see that the return on equity can also be expressed as net income over revenue times revenue over assets times assets over total equity. And in other words, it's the profit margin times the total asset turnover times the equity multiplier. And this decomposition, this representation, in English you usually speak of a representation. And this comes from mathematics. If you rearrange something and express something in it which is the same and which is equivalent, but you have a different way of showing something, this is a representation. You represent it in a different way. Yeah? Okay. And this representation of the return on equity is actually called the DuPont representation. And this is called the DuPont method after a chemical company in the US who first used this and used it in its internal business control. So what does it show you? It shows you that in order to increase the return on equity, you have 3 levers you can use, and you can try to increase the profit margin, you can try to increase the total asset turnover, and you can try to increase the equity multiplier. And this is actually quite logical. It simply means that you can try to make a larger profit on each buck you generate as revenues. You can try to generate more revenues, which each dollar or euro you've invested. And you can, of course, try to use leverage. These are the 3 levers you can use to increase the return on equity. And you can see this is the operating efficiency based on the profit margin. This is the asset use efficiency based on the total asset multiplier. And finally, financial leverage. So 3 levers. First one is more profit out of revenues. Second one is more revenues out of investment. Third one is leverage. Okay. And again, you can see that it is highly desirable to use all 3 levers, but if you are in an industry that is notoriously weak on profit margin, and if you go to retail sellers, this will usually be true. If you are in the business of selling soup cans, you will never innovate a soup can that can be sold for 20 euros. You will never be able to increase the profit margin, especially on livestock and on food products. You know? In Germany, we've had a vivid discussion, a public discussion on milk prices over the last couple of years, because our budget retail stores force extremely low prices on milk products. And why is that? Because they want to marginally increase their profit margin, because they know they will never be able to sell a liter and a pint of milk for 5 euros. Yeah? The price of milk will always stay the same at approximately 1 or 2 euros. So there's no way to increase your return on equity by using the profit margin. But you can try to sell more and you can try to use leverage. So ideally, you would use all 3 levers, but most likely you will concentrate on 1 or 2 and you will accept the weakness in one of them. Okay. Then, last but not least, you also have market value measures that show you what the market valuation of a company is and does actually look like. You can use the price earnings ratio. This is based on the share price. And of course, if you use market data, these ratios can only be computed and calculated for listed companies with a listed stock. Quite interesting. At this point, one has to note that this, of course, requires markets to be efficient. If you base your business and investment decisions on market value measures that are based on market data, you accept the idea that markets know better, that markets have all the information and that markets are efficient. And this is not true all the time. I can still remember a colleague with a link to the Chicago School, who is famous on propagating the efficient market hypothesis, that If you ask people from Chicago and some other colleagues in the US, they will always tell you, well, markets are always right. If markets plummet, if stock prices go down, well, there has to be a rational explanation for this, but markets are efficient and markets will always be right. Then again, you have behavioral finance that tells you, well, sometimes investors are just stupid. And if investors are stupid, markets are probably not efficient and market prices will be off. So these ratios are just as good as the market data is and the efficiency of the market itself is. So one has to be careful when using market-based values and market-based ratios, because you implicitly assume that these stock prices fully reflect the information available on a company. But assuming that market prices are correct, you can use, for example, the price-earnings ratio. The PE ratio is defined as the share price over the per share earnings of this stock. What does it mean? So what is the PE ratio of 16 or 15? What does it tell you on Ryanair, about Ryanair? Yeah?
That you get quite a good payback, 30 cents on $4.6. I don't know if it's really good.
Try to formulate it the other way around. You would have to pay today 16 times the earnings this stock would have generated this year or last year, in the last business year the report is based on. So for example, you would have gotten a dividend of 30 cents if they had given out all the earnings as a dividend. So they have earned 30 cents on a stock, and you would have to pay 4.62 euros for the stock to own. So this means approximately, if the stock price stays the same, it would need 16 years to amortize your cost for buying the stock simply by taking the earnings from each year. So this is a price-earnings ratio. Of course, well, you can see that the higher or the lower the price-earnings ratio is, this tells you whether the company is probably overvalued or undervalued. Another common measure is the market-to-book ratio. The PE ratio tells you something about the earnings on each per share and the stock price. If you take the per share market value and you use the per share book value, you get the market-to-book ratio. And the market-to-book ratio shows you what? Here it's the per share market value divided by the per share book value, but you can also say the total equity over the book total equity, market capitalization and book value of equity. What does it tell you? Same thing we've just discussed. The market-to-book ratio tells you something about the discrepancy between the accounting book value of equity and the market's perception of the true value of equity. And if you have a higher or smaller book-to-market or market-to-book ratio, it tells you how much the market seems to be off or by how much the book value seems to be off, depending on what side you want to take. Yeah?
So would you say the company having a high market-to-book ratio and a really low PE ratio is overrated most of the time? Because when I think of Tesla, it might have a really high market-to-book ratio and a really low PE ratio.
No. Two things. The first one is, this is the book value of equity and the market value. Tesla will have a high market-to-book ratio because everyone thinks this company will skyrocket over the next couple of years. So the market valuation is much higher than the book value of equity because they don't have too much assets actually, and they are still burning money. The PE ratio will look totally different because the earnings are quite low and the stock price is quite high.
Yes.
Yeah. So it doesn't really tell you much about, well, the combination of the two tells you if the company is overvalued and overrated or undervalued. Yeah? If you take just the market to book ratio for a seasoned company, you will probably see that it's an indication of whether a company is overvalued. I think the PE ratio is more sensible to make a stock investment decision, in the short run at least. Okay. Market to book ratio. In this case, it's 2.75, but yeah, that's quite clear. Okay, this is valuation, more or less the very basic ideas behind valuation. Now, as I said, it's much more sophisticated in practice, and you could learn about this more in the valuation class with Professor Diedrich. But what would the next steps be? You would calculate these figures and these ratios, and then you would probably use a peer group, and this peer group analysis would, for example, tell you that a peer group of comparably large airline services and airline companies has a profit margin of 3, and debt to equity ratio of 2.5, and so on. And you would use these comparable peer group proxies and ratios and average ratios, and you would calculate how much should this company be worth if I would compare my company that I need to evaluate with the peer group. In this example for Ryanair, there is only a small need for valuation. Why? Because you already have a stock price. You have a stock price, and you can simply look at the market capitalization of this company, and you have a first indication of what the company should be worth. And then you can try to calculate your ratios from the balance sheet and the income statement. You can compare this with the stock price and market capitalization. And if you see that my impression of the company's worth and the company's value is much higher than the current market capitalization, if the price earnings ratio and the market to book ratio tells you that, you could say, okay, this company is overvalued or undervalued, and I will have to pay more or less for this company. It gets interesting when the company is not listed. If you have a company that is private, that is not listed and doesn't have a stock price, in that case you would do what? You would take the ratios and the figures from the balance sheet, and you would multiply these with multipliers estimated from an average peer group. And for example, you would see that a company or the peer group has an average equity multiplier of and it has usually a profit margin of so-and-so, and you would compare this to the figures from your company you need to evaluate, and then you would estimate a company value. Okay. But at the start, it's all about calculating the ratios and getting an idea of what comparable companies do and have on their balance sheet and their reports at the same time. Okay. Then next, let's go to leveraged buyouts. This is the second large area in which investment banks offer their services. What is a leveraged buyout? A leveraged buyout, in a leveraged buyout, in an LBO, an investor or group of investors buys a target company and finances this purchase with a small amount of equity and a substantial amount of borrowed capital, high leverage. And the profits and assets of the target company are used to hedge the borrowed capital and to collateralize, and also to satisfy the obligations from the debt and to service interest claims. And these leveraged buyouts are typical for so-called private equity investors. This is the usual investment strategy of a PE fund, of a private equity fund, they will try to identify a company that is currently underperforming, that has a good growth potential. They will use a lot of leverage to buy this company. They will change management. They will try to do a turnover, and they will finance this purchase with the assets of the company they bought. And later on, after a couple of years, they will exit via, for example, an IPO or via selling the company to another set of investors, and then they will exit with profit. There are different types of leverage buyouts. First one is a management buyout. This is a purchase of a significant portion of equity by the current management or company's board of directors. What is a management buy-in? This is buying up a significant part of the equity by an external management team. It could be that the managers want to buy another company, and an external management company comes in, and this is a management buy-in. There has been actually management buyouts are quite frequent in one industry. Do you know why, and do you know which sector this is? Where this has happened a lot over the last couple of years? In consulting. In consulting this happens sometimes. Do you know one example, perhaps? Famous management buyout? Roland Berger in Germany. Roland Berger, I think, was sold 10, 20 years ago, I think, to Deutsche Bank. I think some investors took over Roland Berger. And at some point, the managers, the partners, again wanted full control of their consulting firm because they realized that we are working for the benefit of some other investor. And then they rebought their own company. So they had a management buyout. This is what sometimes happens in consulting. I think, what was it? I think there were some other examples in consulting. Then you have a secondary buyout, a leverage buyout of a company in which both the buyer and the seller are themselves are private equity investors or financial sponsors of a leveraged buyout. And a tertiary buyout is a sale of a company through a leveraged buyout that was previously acquired as part of a secondary buyout. So this also happens from time to time, that the PE investor buys a company from another PE investor who had already bought it from another PE investor. So you have a tertiary buyout. These are leverage buyouts. Now, what does the investment bank do in all of this? Because this is a private equity transaction. They usually help private equity funds. First possibility, of course, is they run their own private equity fund, or they help private equity investors to identify potential target companies. They evaluate the target company. They support the transaction. They advise the investors on structuring the financing side of the business deal, which simply means that the investors will ask, okay, we need leverage, we need debt. Where can we come up with the debt? And the investment bank will tell them, okay, we can talk to our institutional investors, we can talk to some other banks, and they might be able to grant you a loan to stem this buyout. So they will advise on the financing side. They will also advise and help the investors to place bonds, to increase debt, debt financing of the new company, and of course they will try to support and advise the investor on the possible exit strategy, for example, as part of an IPO. So it's more or less advice they're giving, and they're helping the PE investors to finance the whole deal. And at the very start, they try to evaluate and value the potential target companies. This is the same as with mergers and acquisitions. This is a large part the investment bankers and M&A advisors will do. They will have a hard time, and they will spend most of their time on the proper valuation of the company. I can still remember one of my law professors. He once made a quite funny remark. He himself was a lawyer. He worked, I think, for 10 years at a top law firm, earned a couple of millions, and then became a professor. So he had some knowledge of the business side of lawmaking and of law business. And he said, well, you all want to become investment bankers. You all want to do M&A. Huh? Look at balance sheets all night. The way this is done is usually that, especially when the company, the target company, is interested itself in being bought, they will open their books. They will put up a room. They will designate this as a data room. They will put all the data they have, all the internal data, patterns, balance sheet information, accounting data, everything in this data room. And then a bunch of investment bankers and M&A advisors will come, and they will spend hours and hours and nights over nights in this data room sorting through the balance sheet and report data the company has given them, and they will try to evaluate the company. And this is why my law professor said, okay, you all want to become investment bankers, spending your nights in a dirty room with no windows, digging through piles of old bills. This is what investment banking then looks like and can look like. Also M&A advice and M&A advisory. This is actually the same. Okay. This is also a famous example of something that could be asked from you in a job interview at an investment bank. Draw up an LBO model. What is an LBO model? You have to come up with an ideal financing structure for a deal. For example, you could be told, okay, you are an investment bank, you're an investor, and you want to buy this chain of perfume stores. Here are the balance sheets. Come up with an LBO model. Okay, so what do? You try to estimate the purchase price. What kind of capital do you need? So it's the company value. You need to include information on the interest rates. You have to calculate the value of the company. Then you have to create a sources and uses list. That is a list of capital requirements and potential sources. You will be given, it's more or less like a case study. You will be given some information on potential investors, how much equity is available, and then you see, okay, you have a private equity investor, you need bank loans, you need to raise capital you need to raise debt by issuing bonds, and you have to forecast the financial statements because the performance of the target company over the next 5 years will determine the financing structure and the structure of the financing for this period. And then afterwards, you have to adapt the balance sheet to the new capital structure because you, as a private equity investor, will try to use leverage to increase what? You've now learned, the return on equity. And this is the business model of private equity investors. Turn around a company, change management, generate new profits, change leverage, and by changing leverage, using financial leverage to increase your return on equity, and after 5 years, you need an exit strategy. Usually after 5 years. And you will calculate the return or the interest for equity investors, and this is the end result. You will see that, for example, for this type of company, for this particular company, based on this data and based on some forecasts you've made, you can forecast a return on equity of 8% for your private equity investors. And then they can decide whether they want to do the deal or not. Okay. This is an LBO model. So which characteristics make a company attractive? Strong, effective management. So after the LBO, you need management to work together with the new owners in order to leverage the company's earnings potential. This usually is done for companies which have growth potential, which have underperformed over the last couple of years. I have one extremely famous example of a company that is owned by private equity investors close to my hometown, and which was famously underperformed enormously. I think it's now in the tertiary buyout, or even the fourth time it has been bought from another PE investor. Do you know any company that has been bought by private equity investors and maybe you also know whether it underperformed, because the targets usually underperform. And I would guarantee you that if you go to this bathroom, you will find one of their products, Grohe. Grohe is a world-leading producer of appliances in baths. If you go to any toilet, you will probably find at least one product, especially in the high-end category. You will find one of their products, and they famously underperformed because they had a management and they were family-owned. The founders in the founding family somehow lost track of the business, and even though they had a large market share, were not able to generate profits. They were bought by a private equity investor. They came up with a new management team, changed the business model slightly, and did a turnover, and it's highly profitable, I think. And they are now, again, market leader, have a large market share, and this is usually a requirement. You will not see a private equity investor buy Tesla. They will not buy Apple, because these are companies you cannot do much. You will not be able to change management, and you don't have any opportunity to do a turnover, and a turnaround. Okay. So one requirement is either a strong, effective management or the possibility to change management. In many cases, the private equity investors will have their management teams standing by to step in if they have bought a company. Then you have a low debt ratio. Of course, this only works for companies which have a high equity ratio, so you can step up leverage. So what else do you need? A solid wealth structure, an asset base. You need to be able to increase leverage. So you need a good asset base, low operating risk, and stable cash flows. So again, you can see these are the pearls in the market no one has seen. And everyone else is just looking at bad current profitability ratios, but the private equity investors will look for some hidden champions. Yeah? Still high equity ratio, perhaps bad management, and low leverage, and high growth potential. Okay. Companies with low PE ratios, parts of the company that do not fit to the group. Okay. This still needs to be the group. It's not the group or the business holding. This is also very frequent in PE deals. You can see that the company, usually it goes like this. A founding group of investors, they became overconfident, they bought up this and that, and at some point they realized the holding is not generating enough profit. Why? Because they've somehow bought up so many different parts that do not fit together that they would need to make tough calls on what to keep and what business parts they should rather sell off. And they are not willing to do so because they have accumulated their whole little empire. And then they start to lose money. And at some point, a PE investor steps in and says, okay, we're buying the holding. And the first thing we do is we sell out those parts that do not fit to the whole picture. This is actually quite a good example. The perfume chain store here. Do you know who's behind this one? Actually, it's a PE investor. And do you know what else the holding company owns? I'm not telling the names here. They are located right next to my hometown. They are located in Hagen, in North Rhine-Westphalia. The holding company owns the perfume chain store. They own a large chain of chocolate stores. And they also own the largest chain of German jewelers. So jewelry, sweets and candies and chocolates, and perfumes. one can get an impression that this is not the perfect, might not be the perfect mixture. Yeah? And the family who owned this holding, I think, has sold off a part of its ownership to a private equity investment company. Okay. These are leveraged buyouts, and it's closely connected with private equity investors. Then now let's go to IPOs and M&As. Two possibilities. You can either try to place your stocks in a private placement, or you can do a public issuing, a public placement. In a public placement, the company shares are traded on the stock exchange for the very first time, and you try to find investors who will give you equity, and they will get the first set of shares. Afterwards, the shareholders can, of course, sell off their shares to other investors, but this is the primary market. It's not the secondary market. If you see a share, if you, for example, are interested in buying a share of Deutsche Bank, you are entering the secondary market because you're not buying the share from the previous owners who issued the stocks in an IPO, in an initial public offering, but you are buying the shares on the secondary market from other investors who might have been involved in the IPO but might also have bought their shares on the secondary market. There are two different types of public issuings and public issues. First, it's a general takeover offer. So in a cash offer, equity capital is sold to all interested investors. For example, you have an IPO or an unseasoned new issue, which is the very first public issue of a stock. And you have a rights issue. In a rights issue, equity capital is sold to already invested shareholders. And this is what we call a seasoned offering or a seasoned new issue. This simply means, what is it in German? It's Kapitalerhöhung. It's a Kapitalerhöhung. Season offering is just an increase in capital, and you try to sell new stocks to old investors, and you increase the number of shares outstanding. Okay. Now, in the public issue, there are several steps you need to take. You need to do a Pathfinder prospectus, you have pre-underwriting conferences, you have the complete prospectus, then you have the public sale and issuance, and afterwards you need to stabilize the market. So what will happen? I'm now a company that wants to do an IPO. I will look for an investment bank that is capable of doing this IPO, of guiding me through the whole process. And first of all, the investment bank or a set of investment banks, a syndicate of investment banks, will advise me on what information to include in the Pathfinder prospectus. This is just a set, might be a PDF, might be a document file that tells investors, I'm the new Facebook, I'm a good company, you should invest in my company, and you should consider buying my stocks. This is done a few months before the offer. Then you have the pre-underwriting conferences, in which you try to convince institutional investors of buying a share in my company. And this might be more or less work for you. In some cases, everyone wants to buy your stock. In other cases, you have to convince institutional investors to buy a small number of stocks. Then you will have the complete prospectus. And all the relevant information needs to be included in the prospectus, or otherwise you're liable to being sued. Okay? Then you have the public issuance and the public issue. The investment banks will sometimes be willing to act as an underwriter, which means that the shares are actually not sold directly to investors, but all the shares go to the investment bank, and it's the investment bank's job to sell off the shares. If they get a better price, the investment bank will make a lot of money, and of course the client will be unsatisfied and dissatisfied with the job of the investment bank. Why? If I am the investment bank and I'm telling you, you can get a price of 30 euros per share, and then you sell me all the shares, 1 million shares, 30 million euros, I give you 30 million in equity, and I'm suddenly able to sell off all the shares for 45 euros, you will realize that you just lost 15 million in equity. You could have raised more capital, but 15 million euros are suddenly the profit of the investment bank. So the investment bank has an inherent, an implicit motive to keep the profits low and to raise as much capital as possible for their clients. Okay, and afterwards, after the public issue, the underwriter, this is the investment bank, it stands ready to place orders to stabilize the price. So if the prices go down, the investment bank will buy up shares on the market to stabilize the price. But they will only do it within a certain period of time, and this will of course be done only for a fee the company has to pay. There are some different types of takeovers. For example, a takeover offer. A takeover offer, when it's public, investment banks are usually involved as underwriters and consultants, and they can give a firm commitment. This means that the company negotiates an agreement with a bank to secure and market the new shares. A fixed number of shares are bought by the underwriter and sold at a higher price, and the investment bank acts as an underwriter as it accepts the risk of not being able to further sell the securities. So if they are not able to sell the stocks, the investment bank will generate a loss. And in order to minimize this risk, usually, especially in large IPOs, not one single investment bank will do the job, but a syndicate of investment banks will be formed, and several investment banks will perform different tasks and assume a part of the risk as part of this deal. And the spread or discount, which is the difference between the purchase price and the offer price, this is the syndicate fee. And as I've just told you, the larger or smaller the syndicate fee is, it will reflect on the performance of the investment bank. Okay. There is also a best efforts deal. The underwriter acts as an agent and receives a commission for each share sold. So not a large risk on this part of the investment bank. But in contrast to the firm commitment, the underwriter does not buy the shares and therefore has no risk. And it's cheaper for the company who does the IPO because there is no guarantee how much money will be raised. And there's also the Dutch auction. In a Dutch auction, the underwriter does not set a fixed price for the shares to be sold, but conducts an auction in which investors bid for the shares. And the bid price is determined by the bids placed. The company then determines the highest bid price for a certain number of shares. Okay. Firm commitment underwriting is more widely used for large issues than best effort underwriting, and smaller emissions primarily use best efforts due to the greater uncertainty of these issues. For an offer of a certain size, the cost of best effort underwriting and firm commitment underwriting are the same. Many underwriting contracts also include a green shoe provision. Its name comes from the company for which it was first done, which this provision gives the investment banks the option to acquire further shares at the offer price. So the investment bank, if it sees that the share price increases, it has the option to buy a certain number of shares at the offer price. And it can immediately exercise this option to make a profit. Why do companies grant such a green shoe option? It's used to cover excess demand and oversubscription, and it's a benefit, of course, for the underwriting syndicate, and it's a cost for the company doing the IPO. And afterwards, this period of time after the first sale, it's called the aftermarket, and during the aftermarket, the investment banks usually stand ready to stabilize the markets in case the share price goes down. Was done, for example, for Facebook. If you remember, Facebook's shares went down extremely in the aftermarkets, and investment banks had to step in to stabilize the price. Okay, and as this is already close to Christmas, I will stop here. Do you have any questions? Have a look at the IPOs. We'll continue this in the next year. And after we've concluded our discussion of investment banking, we'll come to bank accounting, which is, of course, specific to German laws. Okay, if you have no further questions, thank you for your attention. Have a great holiday and see you next year. Thank you.